Hi everyone, we are going to do a follow-up to trend lines basics that we did in our previous video. Now if you have not seen that video, you will find a link of it in the comment section and you can go and take a look at it first. And once you have done that, then we are going to today go over trend channels, which is basically one step ahead of using trend lines. Now anybody who has studied Elliott wave analysis would know the importance of trend channels in setting price targets and getting the price trajectory right. We are going to be looking at the use of the combination of the wave analysis with trend channels, but even if you are not someone who practices Elliott waves, you will find this extremely useful in terms of how we go about setting targets, because it's easier than using Fibonacci numbers and relationships, which are the common tool of Elliott wave analysis. It's very simple to apply channels to know where prices are headed next. So let's get started. I'm going to start by looking at the price chart of gold. This is gold in 2016, 2017. Like I said, that you need to look at the trend channels video first, but this is basically one step forward. So what you're seeing at the bottom of gold here is, note that we always start channeling or trend lines from the most important or significant low, which means prices were falling throughout this time period and then they were rising after December. So we take this significant low as the starting point. And once we've chosen a starting point for price is where we want to start drawing trend lines and trend channels. So the first thing we do is we draw a trend line for the first two lows. Okay, what an Elliott wave analyst would do when he does that, when he gets the first higher top, higher bottom formation, is he would end up marking waves 1 and wave 2 at that high and at that low. The question then would become, where do we project next for wave 3 to go? The very simplest technique explained by Robert Prechter and in his book Elliott wave principle essentially is to use this channel as a targeting mechanism, because 5-wave impulsive moves of the market end up following channels very particularly. The entire move fits inside a channel most of the time. There are times that prices can move above or below the channel, but you can always adjust them and then continue forward. So we're going to look at how we do that. So what you're seeing in this gold price chart is I've drawn a parallel channel, which is after joining the two immediate lows and drawing a trend line, I've taken a parallel line of that and pushed it to the top of the range. Once I do that, I'm able to project where prices should head next in the third wave. So the upper end of the channel in this chart was approximately here, as you see, and prices have moved up to touch that point at $1175. In fact, they've moved up slightly above that. Now, once you've moved up and pulled back a bit, again, an Elliott wave analyst would say, fine, we've possibly completed a third wave over here, and we mark that as 3 and we mark that as 4. But the question at that point is, when you actually reach point 3, where are we going to go down in point 4? So what we do is we readjust these channels and we draw what is called a reverse channel. Now what is a reverse channel? A reverse channel is a situation where you draw a trend line of the highs and not the lows first. Okay, so I'm going to do that. I've drawn a trend line which moves from 1 to 3 first. Okay, and then I draw a parallel line to that and join it to the bottom of 2. This gives me a projected point for a correction in wave 4. Now note, prices have not fallen back there, but sometimes they do. Eventually, at a later point in the chart, you're finding that prices are taking support at this lower end of the channel and continuing higher. So this gives us a projection as to how far a fourth wave correction can happen, and after that we look at where the fifth wave can go. Now if the channel is not broken, we don't need to readjust the trend channels anymore, and it ends up capturing the entire trend up, and we are able to mark the fifth and final wave at the next meaningful high. After that, of course, we've seen a correction. The trend channel also broke, and so this becomes a much larger degree first wave and a second wave. Now a very similar technique can be used to project even higher degree waves. So I can actually move ahead and consider that this first wave will help me project where the third wave is going to go at a larger degree of time. So by drawing this parallel channel, I can actually make higher level projections. So what I'm going to do, rather than just look at the gold price chart, I'm going to move over to Nifty. Okay, and Nifty is something that a lot of people consider. Okay, so we are going to look at this price chart of Nifty, and I'm looking at a chart from again 2003 to 2004. Okay, and in this chart, what I'm trying to show you is that it's the same technique applied quickly from the bottoms. So if you are looking at the first wave, our initial projection would be to draw price channel and expect prices to move to the top end of the channel. Now once they've done that and they've overshot, we initially draw a trend line of the two lows. Now I've already explained exactly this chart in my last video using the Sensex, that we essentially end up drawing a trend line of the lows which takes all the price action at the top end into account, and then we draw a parallel line to that. When we do that, then we are able to again project higher levels. Similarly, we also draw trend lines of the tops to project the downside. Now you notice this is a fast advancing market, so each time we draw a trend channel of the highs and we project it to the downside, prices are actually not pulling back that much. So this channel therefore loses its significance in favor of the next important trend line that captures most of the trend. Now you note that this third trend line has captured most of the trend, and if I draw a parallel line, the entire trend was inside this parallel line. Okay, so this was the initial wave 1, wave 2, wave 3, wave 4, and the fifth wave ended up taking an entire channel of its own all the way to the end point. Now I just discussed on the gold chart that we can actually move one level higher on our wave markings, okay, and I can mark waves 1 and 2 for this entire trend that has occurred and ended in July of 2004, okay, and 2003. And what we do there is we now join these two lows, drawing a broader trend line for this entire trend, and then project a larger degree third wave to the top end. Okay, so when we do that, you note that we've reached the top end right here, okay, and actually pushed slightly above it in what we are calling a third wave. Now when that happens, we want to look for the next correction. We apply the same methodology again. We take a trend line of the highs and draw a reverse channel, and you note how the reverse channel was achieved. In fact, prices fell below it in this fourth wave, and this drop back below is what we call a throw under. Now typically when you get a throw under in price, Elliott wave analysis suggests that you will also get a throw over in prices in the subsequent move up. Okay, so that's what has followed. Also, you note that once we take the most important trend line that includes all the price action for this pattern, you will find that you can also project the fifth and final wave for this entire move. Now, I'm not getting into Elliott wave analysis explaining as to how you mark these waves, but essentially this was a third wave that was extended. The extended move continued to move to the upper end of the channel repeatedly, which is why I have marked 3 here and 4 here, and this entire rise, this entire 6-month advance in the market, where the Sensex went from almost 3,000 to 6,000, doubling itself, was a 5-wave advance that ended up completing exactly at the top end of the channel. So this is why we are able to use trend channels along with Elliott wave analysis to project what our price targets are going to be. Elliott wave analysts also use Fibonacci numbers like 1 time, 1.618 times, 2.618 times to make these projections that often match what the channels themselves are showing. In certain price charts, you'll also find, like I showed you in the initial stages of Sensex, that the price channels continue to steepen, which means the price moves up faster and faster and you have to readjust your channels on the way up. The same can also happen sometimes in a market that slows down, where you have to adjust price channels downwards, similar to what I did in the first wave. So once wave 1 completed and prices fell a lot, I readjusted the entire channel to the lower end to include all the price action that was happening over this entire time period. So trend lines and trend channels become extremely dynamic processes. Trend lines also need to be adjusted so that all the price action above the line is taken care of, and trend channels then need to adjust to set with how the entire wave formation is developing. The importance of channels is what they give us is an important resistance level, a cutoff point where prices could top or where they could pause before the advance continues. And once you're able to get there, you're also able to project how far a correction might occur in the subsequent period. these channels need to be adjusted on an ongoing basis so that you can come up with new levels as the trend goes on till you complete what we call a 5-wave advance. A 5-wave advance or a 5-wave decline is one part of a trend in Elliott wave analysis that completes itself, and then after that you expect a correction, whether it's a smaller degree 5-wave move or a larger degree 5-wave move, and channels help us capture that entire move altogether. So that's all in this session for you. Thank you.